Asset allocation is commonly discussed with a lot of people, especially those that are near retirement. Now, there's a lot of theories behind all of this. The going rule in the past was you take 100, you subtract your age, and that's the percent of your money you should have in stock. So if you're 30, 100 minus 30 is 70. You should have 70% of your money in stocks. Well, a couple of things have changed. One, people are living longer. And two, I think over time, there'll be a lot of demand for employees as our growth rates as a population decrease, and it'll allow for people to make more money later in life working. So that combination right there allows people to live a little bit longer. Now, I also don't believe that somebody who's 30, this is my personal opinion. I'm not saying it works for everybody. But for me, personally, when I'm 30, I don't want to have a single dollar in anything but stocks. I want a dollar cost average into stocks for a very long time. Why is that? Well, if you look at rolling averages of stock market, from the age of 30 to the age of, let's say 70 till you work, that's 40 years. Over a 40-year period of time, if you dollar cost average, you're going to do quite well in the market. So no reason to have bonds. You don't need the income. Why do any of that? Put yourself in good assets, the stock market, and a low-cost ETF, and keep riding it out for a very, very, very long time. Now, let's say hypothetically, you're later on in life, 55, 60, looking to retire in the next 10 or 15 years. What should you do? Now, this is very tricky because we see a booming market, you feel good, your stocks are going up. Hey, if I just stayed a little bit longer, I can make more money. But there's also a chance of what happened this year. A 20+% drop in your money over a 9 or 10 month period of time when you're 60 and you're looking at retirement 5 or 10 years from now, that sucks. So you first have to be honest with yourself. What are my goals? If my goals are to retire and I have enough to retire at the age of 60 and I'm not retiring for 5 or 10 more years, take money off the table. Why put yourself in a position? As Warren Buffett says, and I love when he says this, why risk what you have to get what you don't need? If you don't need the money, pull money off the table. If you do need the money, it's a tough situation to be in, but you have to be honest with yourself and realize that there's a chance you might have to work longer. Now, on this channel, I discuss the stock market to GDP ratio. This is the most, according to Warren Buffett, the most accurate measurement of stock market value at any given time. So I created my own version based on the S&P, and I have it right here. And I'm bringing this up because I want to show people where we stand in the market today and what that might mean for you in the future. So I extrapolated the September GDP numbers. I don't know exactly what it's going to be. I just put it in there based on estimates, and the S&P 500 based on wherever it was the other day. So right now we are based on history. The historical average is 0.929, converting this to a stock market GDP ratio. The highest ever was 2.5, the lowest ever was 0.329. So we're the overall average is 0.929. We're currently at 1.439, which is 55% over value. According to this metric, fair value is about 2,300 in the S&P. That's a big drop from today. Okay, that's something that you might sit there and say, wait a second. Now, I'm not saying that the market's going to go to 2,300. It could take years for that to happen, and that time GDP goes up, and it's a combination of both. However, I do see a lot of frothiness in the market. I see a lot of average people thinking they're great investors. I don't see people behaving the way they should at market bottoms. We need people giving up. I still don't have that. I still hear regular people talking about stocks, talking about Bitcoin, talking about EV. That's not what you expect to see at the bottoms of markets. So let's look back at history and see how reliable this metric is to future returns. So I ran this from this year all the way back to 1929. And guess what, guys? There's a thing called correlation coefficients. It ranges from -1 to 1. -1 means perfectly inversely correlated, which means if it goes up by 1, if one metric goes up by 1, the other one goes down by 1. If one metric goes down by 1, the other one goes up by 1. Perfectly correlated. 1 to 1 is if this goes up 1, the response is up 1 in the next variable. Okay? And then something is 0, which is no correlation whatsoever. It's completely random. Now, when I run the stock market to GDP ratio, where it stands and what it means for future returns going back to 1929, the correlation coefficient is negative 0.81, which is a very, very high negative correlation. The higher the stock market GDP ratio, the lower returns. And this correlation is very, very strong. Ask any statistician. This is a very strong correlation, and it makes sense. If you want to compare, if you want to look at the companies in the U.S. economy, they should somewhat, especially the largest ones, should somewhat emulate the U.S. economy as a whole. As the U.S. economy gets bigger, these will get bigger. It's not possible for these ones to forever grow faster than the U.S. economy, so those things should should work together. Now, what does that mean on a couple other levels? Okay, well, let's look at this number. The historical average, not including dividends, is 6.6% in a rolling 10-year average. When you're investing when it's undervalued, the average is 9.3. And when it's overvalued, it's 2.3. This doesn't factor in how overvalued or how undervalued, but you can imagine the more undervalued the stock market GDP ratio is at any given time, the more the return, the more overvalued, less returns. So let's go. Let's look at 0.329. I just know that one because it's 1982. Let's go to 1982 and find that 0.329. Here it is right here. It said the stock market was 64.6% undervalued. And look at the future returns that happened, 14.1%. Okay, now let's find 2000, which was a very overheated market. March of 2000 was the peak right here. The market is at 1.461, which is very similar to today, overvalued by 57.3. The future 10-year returns were negative 2.6%, not including dividends. Adding in dividends to that, it was about even, maybe a little bit low. The market actually lost money over 10 years. So the reason I bring this up is we are currently at 1.439, and look at the 2000 numbers, 1.461, overvalued, bad returns. Look at the overvalued numbers here, and look at the returns here. Very, very bad. That's the point here. So does that mean you can't make money? No, as long as you're willing to dollar cost average along the way. And if the stocks go like this, remember, start here, drop, and go here again. If you dollar cost average along the way, you pay this. So you still end up making money along the way. You overpay sometimes, you underpay sometimes, and overall you still make money. And that's the key here. So it doesn't mean you can't make money, but it does mean that as a person getting close to retirement, it can be emotional, and you have to be ready to sit there and say, do I really need this money to get there? I would rather have you investing your money. And this is my opinion on this. You should talk to your accountants, financial advisors, whatever you want. But my opinion is be honest with yourself about when you want to stop working. Where we are today in the market cycle, based on a lot of things that I see, especially this reliable metric, tells me that the next 10 years are not going to be good. If they're not going to be good and you plan to retire in the next 10 years, be ready for a lot of volatility. If you can be ready for a lot of volatility and you can ignore it and just keep averaging every single month, you will make money from here for the next 10 years. Your current money will probably be about even, and the money you add to it will grow a little bit. That is the key there. Now, let's say you're 30 years old and you're like, I'm going to retire in 70 years. How does that look? The market's really expensive. Well, let's go back really far. Let's go back to where the market was massively overpriced and see where stocks ended up going for the next 40 years. So I'm going all the way back to let's pick a date here. That's the thing. We've had really overpriced markets we have to go back to 1939. We were at this level, but where stocks were 53% overvalued. Now, this goes back a ways. You might sit there and say, oh, the market was different back then, but a dollar of cash flow was still a dollar of cash flow, whether it was then or now. And these same things have applied, these same metrics have applied over 150 years of stock market history. But again, going back here, the S&P equivalent was 13. Now, that was 1938, end of 1938. So let's go to 1978. So remember, S&P was about 13. And in 1978, S&P was at 100. Okay, so you still got 6 times your money over 40 years. And all along the way, you were dollar cost averaging. So you can still make a lot of money along the way. Go back 40 years from today. 40 years from today was that low of the market. And the S&P then, in 1982, was 132, and now it's at 3,600, 20 times more. Even if the market goes to where I think is fair value, 2,300, 2,400, 2,200, you still made 15 or more times your money. So you can still, over 40 years period of time, still make great money. And it shows that we have another video where I showed that if you invest more money when the market's below its historical average, you absolutely kill. Overall, you get about 50% more return on your money by investing more when the market's down. So next question you might have is, well, Paul, I'm a little bit more astute. How do I buy individual stocks? Well, that's a great question. And the reason being is individual stocks are a way that you can sit there and play specific exact companies that you like for the right reasons. Good balance sheet, good cash flow, and most importantly, a low multiple of earnings and cash flow. That is what's key here, okay? When you pay a low multiple of earnings and cash flow, and you're able to do the same thing that I just mentioned here, but dollar cost average into great companies, I personally believe that the Microsoft, the Apples, the Googles, I believe these companies will be undervalued at some point in the future. No companies are ever overvalued forever. It has never happened. It never will happen. Investments eventually wear themselves out. The same reason people ride them up when they're not moving, they're going to just sit there and start exiting them, and it makes the stock fall. So how do you buy those companies? Well, if you're new to this channel, we have our 8-pillar process. We have created our software. This software is specifically dedicated to understanding individual companies and buying them using a process. Let's pull up Microsoft, for example. I love Microsoft because it's a company that I cannot wait to buy. I absolutely cannot wait to buy Microsoft. It just has not hit my price yet. I don't look at a company, I don't look at a ticker symbol as buying a ticker symbol. I look at it as buying a piece of a business, and that business generates income and cash flow and has a balance sheet. My goal is to pay a lower multiple of that. I'll pay a higher multiple for very good growth rates. But if it's not going to grow a ton, I need to pay a lower multiple to get my returns through cash flow, buying back shares, and paying dividends. That's just the way it works. Now, you look at the 8 pillars here on Microsoft. This is a great scenario. Our pillars, the 2 X's are our 5-year PE and 5-year price to free cash flow. So without knowing the growth rates, this just tells me this company's potentially just more expensive. I want it to be under 22.5 for both of these. It's at 38 for both of these. Okay, but the other metrics I love. They get a higher return on their invested capital, double what we want. They've had revenue growth, net income growth, cash flow growth, low debt. They can pay off their debt with about 2 years of their free cash flow, and they're buying back a few shares. And as time goes on and the company gets cheaper, I'm really hoping this share buyback really increases, because this is a company that's making tons and tons of cash flow. And at that level and that size, there's only so much you can do to generate high returns and add more returns to your company. When you're doing $200, $300, $400 billion in sales a year, how do you possibly grow that much faster? You're such a big piece of the economy. Literally, you're so saturated, it's hard to grow at very high growth rates. So how do you reward investors? You pay them dividends, you buy back shares, and you make the balance sheet better. And that's how you do it. But we want them buying back those shares at lower prices, not at high prices, because even though they're buying back their shares, they're still investing the money that you have a right to by being a shareholder in the business. This is extremely key. Now, when you've done your analysis, you sit here, you can look at the analyst estimates. You sit there and say, okay, well, analyst estimates for earnings per share are doubling in the next 5 or 6 years. Here's the growth rates. You go down to revenue growth, because I talk about how revenue growth is important. You're looking at double digits here, 202 billion to 375 billion. And then you use this information into our most popular tool, which is the stock analyzer tool. Every investment's the present value of all future cash flow. So your job is to make assumptions about the future, and it'll tell you based on those assumptions what price you should pay for the company, not including the balance sheet items. So any sort of cash flow is a return to you. And the less you pay for that cash flow, the higher your annual return. It's a very simple, it's just math. The more you pay for a future stream of cash flow, the less your return, the less you pay, the higher return. They work inversely. All right. So on a company like Microsoft, I'm doing a 10-year analysis, and those analyst estimates were 5 years. So I'm going to decrease them slightly. I'm going to go 4, 7, and 10. Profit margin, I do think it's getting better, but I'm still going to stick with 28, 30, and 32. Same with free cash flow, because over long periods of time, free cash flow and earnings are the same. And for my PE and price of free cash flow, as the company grows and grows and grows, you can justify a higher PE for higher growth rates. But as it grows larger and larger, it's harder to grow. Think about it this way. Is it easier for a company to go from 100 million in sales to 200 million, or 100 billion in sales to 200 billion? That's a pretty obvious answer. So as it's bigger, it might have a bigger moat, though, that can justify a higher premium to the company. So it's a nice balance, and it's completely subjective. This is the art of investing that we talk about on this channel and in our community so much. All right, so I sit here, and I'm going to do 13, 15, and 17. And then for both price of free cash flow and PE. And the final input is my desired annual return. What return do I want on my money? You can get 9 or 10% over very long periods of time by investing in a low-cost ETF. So if you want an individual company with ample margin of safety, you need to make this higher and higher. As I make my assumptions bigger, I want larger margin of safety because it's less likely to happen. So for this one, I'm going to do 12, 13.5, and 15% return. I hit the analyze button. Now the key here is, guys, there'll be 6 numbers that pop up. Three based on a multiple of earnings and 3 based on multiple of cash flow. If it's all green, it doesn't mean go out and buy. It means do your research. And that's the key part here, guys. The key here is sit here and verify all this data. How do you verify it? Well, easiest thing to do is join the community. Go in there, spend less than $1 a day, and you get access to everything you've seen. And you get access to our mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, daily content that Mo and I make specifically just for people in our community, access to Mo and I. Just tag me. When you join, tag me, say you're new, say hi. I have an 80% chance of responding. I respond to dozens and dozens of messages a day, so keep engaging. Real estate calculator, so a way of looking at real estate calculator, so a way of analyzing real estate the same way we do with stocks, stock screeners, retirement calculator, and the EM community chat. All of this, guys, for less than $1 a day. Our competitors are way more money. So again, back to the community. You have this community chat. You can go in there, thousands of investors in there talking about all these companies. They engage every single day about companies, about crypto, about everything you can possibly imagine. Life mindset. I do quotes every day where I talk about the quotes and how they apply to personal life and investing. This is a community about mindset, about emotion, and about process, because those are the 3 things you need to be successful in investing. And if you can do this for less than $1 a day, and it just increases your return by 1% a year, the amount of money you will have extra will be hundreds of thousands, if not millions, depending on the amount of money you invest. So it's incredible. So again, back to analyze this company. $238 is current Microsoft price, and makes sense. Too expensive. Low price is 100, high price is 160, mid price is 125. I have it on my watch list. Now, let me show you my watch list. This does not mean at my watch list at 200, I'm going to buy it at 200. What it means is, Paul, it's getting close. Start doing your research. Make sure you're right on your numbers and start selling puts to buy the stock at lower prices, because that's something I do to generate income that we've helped a lot of people understand in our community. So this is my watch list. I have 99 companies on my watch list currently. I do every single company. I go through them, I input them. I don't want to keep track. I want the software to keep track for me. That is the whole point of the software. Notify me when the stocks have hit their prices. Then I'll go in and reevaluate them, recrunch the numbers, take my bias out of my previous example, just go in there, recrunch the numbers from a purely clean slate. And if it still makes sense, I make my decision whether I'm going to buy, do more research, sell puts, whatever it is. And that's the point of the community. All right, guys, click right here, go to everythingmoney.com, sign up. It'll be the best financial decision you made.